So 5 things to look out for before you place a trade. Hey guys, I'm Jerry Green from Value Flow Trading, and today I'm going to be sharing with you the 5 things you need to look out for before you place a trade. A top-down approach, if you would, a strategy or a checklist more preferably. But these are the 5 things you need to check out. These are the 5 things traders check out as a beginner or an intermediate. Mostly for short-term traders, and by short-term traders I mean day traders, swing traders, and possibly scalpers. 5 things you need to look out for before you place a trade. If you understand this, or if you inculcate this in your trading strategy or your trading edge, they could increase the odds of your trade working out exceptionally. So these 5 things are important, and we're going to jump into the charts and I'm going to show you what they look like. The 5 things to look out for before you place a trade. So hey guys, and welcome again onto the chart. The first thing we look out for is market structure. A market structure tends to give us it tells us what the market is doing. If the market is trending, the market is ranging, or if the market is too volatile for us to stay out. We tell this using the higher time frames like the daily time frames and the H4 time frames. Remember, for day traders, swing traders, and scalpers, use the daily time frame and the H4 time frame to frame your directional bias, and use the smaller time frame to actually use for entry. The higher time frames give you a sense of direction, and the subsequent lower time frames like the H1 and the minutes time frames for entries. So the first thing we look out for is market structure, and this tells us what the market is doing. Now, when the market is in a trending market condition, you want to apply trending market strategies to the market. You want to apply trending market strategies. Take, for example, this market is on an uptrend. You want to be a buyer. You want to use tools like Fibonacci, like trend lines, like moving averages, tools that will help you join the uptrend. Now, the next thing that we look out for is key levels. Yes, key levels. And key levels could be point of interest, areas of value. Doesn't matter what you call them, it just has to do with areas on your chart that the market will slow down and the market will come down to pick up more orders and to move up. If the market is moving upward, you don't want to jump into the market. It's like jumping into a moving train. A train has to slow down to pick up people, the same way the market slows down to pick up orders. Those specific zones or areas where it slows down are known as key levels, points of interest, areas of value. Doesn't matter what you call them, it just has to do with places where prices will slow down before they move forward. Key levels have to do with support and resistance, supply and demand zones, round numbers. We've done a video about the difference of supply and demand and support and resistance, so we'll put it in the link in the description, so do well to check it out. Also, if you like this video so far, hit the thumbs up button, and if you're new to this channel, subscribe. Now, the third thing we look out for is confluence and entry triggers. Confluence is super important, and we've also done another video on confluence. We put that link in the description too. Make sure to check it out. So confluence has to do with many layers of support to your trade. If you're somebody that focuses on the chart, pay attention to support zones, moving averages, and trend lines, and momentum indicators like RSI, CCI, MACD, stochastic. And as beautiful as all this sounds, please just pick one. They all do the same thing. They just show you overbought and oversold levels. Of course, the settings could be different, but please just pick one. One is enough. You also want to add confluence to your trading, and take a look at this example. We have a trend line, we have a moving average. Notice how price respects the moving average and the trend line, and overlaying this with the CCI momentum indicator. For every time the market hits the trend line and the moving average, look how CCI is oversold, giving you an indication that the market could go or higher, acting as confluence. And your entry triggers are like candlestick patterns. Where price hits those levels, you want to see a confirmation of a candlestick confirmation, bullish engulfing pattern, hammer pattern. It doesn't really matter, just the candlestick patterns that show you that the buyers are back. Also, we've done a video on candlestick patterns, so please do well to check it out. We'll link that in the description below. And to see how beautiful and clean this example is, you have your trend line, your moving average, your CCI that act as confluence to support your trade. The fourth thing we'll look out for is news, earnings, and intermarket analysis. You don't want to be trading a bubble. I know that most technical traders don't want to pay attention to fundamentals at all, and that's fine if you are good at it, but you have to pay attention to high impact events. You have to understand what's happening to the global economy, even just for the basis of understanding, because you don't want to be caught off guard. Like a very user-friendly calendar tab is the forex factory. Just go to your calendar tab and pay attention to the red and medium, the high impact and the medium impact event. They are super important, so the market does not catch you off guard. Pay attention to big news events and major news events. Like last week we had the Silicon Valley crisis, and if you did not know about it, you'll be caught off guard, because traders who kept on buying the dollar kept being stopped out and they could not explain why. And this is why fundamentals and sentiment comes in, and into market too, because also some asset classes move in tandem with others. And if you do not know intermarket analysis, you will be caught off guard trying to buy a particular asset when another one is dragging the same asset down. So you need to pay attention to intermarket analysis. They act as major confluences to your trade. And finally, the last thing you want to pay attention to is your exit, your stop loss, and your take profit. You set your stop loss in places that when price gets there, your trades are invalidated. So if you are buying, you place your stop loss where you know that when the market goes there, your buy is no longer in your trade. You set your take profit based off of market structure or places where you expect the market to turn. So TP based on market structure involves when you see the market, you are buying and you start seeing the market making lower lows and lower highs against your trade. You want to probably exit those trades, and then if prices, place your take profit at places where you expect price to get to and turn. Now, in summary, the checklist and the 5 things we look out for: market structure tells you the trend, key levels tells you places where you want to be interested in buying. You don't want to jump in front of a moving train. Confluences and entry shaker gives you layers of support where you will inclined and encouraged to buy, and it confirms your bias. Use candlestick patterns or use momentum indicators for your entry triggers. Use news, earnings, and intermarket analysis. Use Forex Factory for news. Use Yahoo Finance and Investing.com for earnings. And do not trade in the bubble. Use intermarket analysis. Set your exits, set your stop loss, take your take profit. This will be all for today. Wish you good luck and good trading. Cheers and God bless.